Got your attention. Ladies and gentlemen, we're moving in now to the afternoon session. Thank you very much. I hope you all enjoyed your lunch. In your packs you'll find some feedback forms, so be very keen to see you fill those in so that we get information back that we can use in order to improve what we offer, make sure that what we're doing for you is relevant. So please just take a bit of time as you listen to the different debates and reflect, just to give us your views. That would be gratefully received. Investment is the fuel needed to secure further growth of the small and mid-cap company sector, which is why this next session is so important. One of the QCA's key campaigns over this year is to look at how we can incentivize more investment into the sector. And an overarching desire of ours is to have small and mid-caps designated as a separate identifiable asset class, so that various policies both in the European and in the UK arena can be applied to just those companies. As well as that, we're looking at ways of encouraging the government to incentivise investment through fiscal policy, such ideas as reforming capital gains tax. And it was interesting that David Gork mentioned looking at EMI schemes and changing entrepreneurs' relief in that area. That is something we'd like to see extended much wider. Also allowing AIM Plus shares to be allowed to be included in ISAs. It's been a long-standing campaign of ours, and Mark Hoban has slammed the door shut on that on several occasions in public, so I don't hold much hope for that one. And eliminating stamp duty. Those are just some of the areas that we're looking at, and I throw that in order just to get you thinking, because we would love to hear views and feedback on that sort of thing. I'd now like to welcome our next panel, which I've got the honour of chairing. This is a unique opportunity to hear from that rare subspecies of institutional investor. That's the subspecies, the ones that are still active in the small and the mid-cap space. And hopefully we'll find out what they think can be done to channel more investment into the sector, and also how they interpret the current environment for small and mid-cap companies. Joining our panel on my left, we have Adam McConkey, Fund Manager at Henderson Global Investors. Adam joined Henderson in 2011 as Director of UK Smaller Companies, having been at Gartmore for more than a decade. To his left, we have Judith Mckenzie, Fund Manager at Downing. Judith joined Downing in 2009, previously having been a partner at Acuity Capital, managing AIM-quoted VCT and IHT investments, as well as a small-cap activist fund. And to her left, we have Andrew Buchanan, Fund Manager at Octopus Investments. Andrew joined Octopus in 2008, having had well over, well, it says here 30 years, but I seem to remember him longer than that. 30 years investment management experience gained from institutions including, and the list includes, but it's not exclusive to, Barclays, Horgavet, Mercury Asset Management, as well as Close Brothers. We've asked each speaker to give their views on how they believe we can channel more investment into the sector, and also what their view of the market in the current environment is. So I'd now like to welcome Adam to give his viewpoint on life as an investor in the small and the mid-cap space.
Thank you. Thank you, everybody. First of all, thank you for inviting us to talk today. I think I probably ought to start with a confession. I don't know if the Henderson advertising campaign has registered in our association with Jose Mourinho, who I think probably is single-handedly responsible for a generation of investment managers who are going to work without a tie on. So I purposely put a tie on this morning, and Andrew's just pointed out on the way in that actually it's the same tie that's in the pack with our pictures. So I do actually have more than one tie. When Tim invited us to talk, he posed a number of questions. I think it's probably in your interest that I try and curb my natural verbosity and just pick up on a couple of them as a starter to set up a conversation for the next hour or so. And those two, is there money to invest in the small cap space? and what is your view on current market conditions? Current market conditions, we can look on the short term and the long term. Clearly, at the moment, it's an incredibly difficult period, and it's probably as dysfunctional internally, the market, as I can remember at any point during my career. I suspect Andrew would probably back me up on that over a more extended period. What I wanted to do, though, today is root the debate in a long-term secular pattern, because current market conditions for small and mid-caps, the prevailing macro uncertainty is just, you know, an additional headwind that small cap investors have been facing for an extended period. To put it in stark terms, I've brought a couple of slides along, which are very instructive. This first slide is IMA data, so Investment Management Association data. The top chart shows the flows of retail, as in mutual fund money, and institutional flows into the small cap space over the last decade. Actually, if you track this data back, they only release it in decade packets, but if you track this data back, it's the same fairly sorry picture, that there have been very persistent outflows from the asset class for a very extended period. I think that correlates almost perfectly with the credit cycle, and I'll come back to that in a second. The bottom slide shows an almost perfect inverse correlation, which is UK investors investing overseas and in emerging markets. What I think has been going on here is that if we roll back the clock to the late 80s, the beginning of the 1990s, the end of the Cold War, where the beginning of the globalization of capital flows starts, is that there's been a profound and long-term structural shift away from UK equities, and a profound and structural shift away from UK small caps. Just as initially you had McDonald's able to go and open stores in Prague, Ukraine, Moscow, etc., the bond market chased that, the big American banks chased that, and very shortly afterwards you ended up with UK equity mandates being globalized. So not only was there a substitution from UK pension funds and institutions away from equities towards bonds initially, which accelerated later, but subsequently to that, there's been a very substantial shift away from UK equity per se. Very roughly speaking, you could look back and expect of an equity allocation of most pension funds, anything between 60 to 80% would have been invested domestically. Today, that's reversed completely. The globalization of mandates, emerging market funds, EFI products, BRIC products, and so on, it's probably nearer 20%. And what I think's happened is emerging markets have become the substitute for risk or growth capital. So that's the headwind that I think the small cap space has faced for a very extended period, and I think also sets a backdrop for some of the policy debates that are emerging now, and the initiatives particularly the QCA has been pushing. It's not a particularly attractive one, I recognise. So in that context, it might be, if you ask me what's my view on the current market conditions, it might surprise you that I'm actually very excited as an investor. And part of the reason for that question is if you look on the supply side of what's happened in the UK. This is if the demand picture has collapsed, we've seen the way the credit cycle impacted upon the UK small cap asset universe was not in the use of complex derivatives or unnecessarily or undue use of leverage among small cap companies, but in the proliferation of the number of companies listed and the great success of AIM, peaking out at the top of the cycle at nearly 1,600 names. Now the good news is that clearing process, there's a clearing process that's advanced, is already advancing. The number of names has already shrunk by some distance to around about the 1,100 mark. And I think continues from here for 2 or 3 reasons. The first one is corporate activity. That's not going away. trade is recognising the disconnect between market perceptions and business reality in this asset class. In addition, what we might call fed-ups, I'm sure there are a number of companies who are quite fed up with their share price out there. We're seeing increasing numbers of companies who are looking at delisting an alternative or relisting elsewhere. And thirdly, failure. I mean, failure is ultimately a good thing. It's part of the cleansing process. If you put these two slides together, what it does mean is you've got a very good old-fashioned economic problem of scarcity and choice. There's a scarcity of capital and too much choice for people like ourselves on the panel today. That, for me, is a recipe for highly inefficient market pricing, a large disconnect between market perception and business reality reflected in share prices, and a fantastic opportunity for those who have the wherewithal to commit capital to the space. The problem, of course, is either the wherewithal, particularly in the shorter term current market conditions, or actually in terms of the policy incentives that are lacking to encourage investment in this class. And I think that's probably the best point at which I should leave it for the others to carry on.
Judith.
Okay. I suppose I have to declare a bit of a conflict here, and it's going on from one of Adam's points about the inefficiency of the market. In some ways, I almost don't want to sort of talk about trying to make it more efficient and a better place to be for quite a lot of you guys, because actually the whole point is that the hunting ground that we have, that I have, is fantastic. I love it being inefficient. I love that there's more sellers than buyers. I love that there's pressure on your share prices half the time. And actually, I don't really mind that the trading platforms don't work too well, because we can exploit that, and we can always match buyers with sellers ourselves if we're smart enough to do it. So that's the first conflict, I suppose. It might be a rather selfish way of looking at things, but one of the other questions that was posed was, how do we as investors, and what are we looking for in companies? We are just very, very basically looking for decent companies that would almost buy in the private arena all of, 100% of. So just going back to very, very basic investment principles, and we'll maybe come on to some of those later on. We don't really care about EV, EBITDA and PEs and stuff like that, because that's a market value, and the market, as we just talked about, is highly efficient. So the question of where the market, whatever that is actually going to go, I can't actually profess to give you a graph and tell you a forecast, an economic forecast. I can pretty much guarantee the market, our market, the small cap market, is going to go down. Marvin King has already told us that we're in the middle of one of the worst economic cycles in the last goodness knows how many years. So I can guarantee it's probably going to go down, and I can probably guarantee you that the headwind that Adam's talked about is probably not going to change. And we can talk about some of the aspects in terms of dancing around the edges and policy, and the QCA has got a big job in front of it in terms of lobbying to get some of these changes, the structural changes that we need in the industry, and that again is not going to change overnight. So I think we probably have to deal, sadly, with the reality and the hard, stark reality of the current structure that we've got. I don't have any magic wands to wave, but I've got probably a few views on why, aside from the macro, as to how we've ended up where we are. And if you look at the IMA sectors over the last 10 years, as Adam said, the money has been going out of the sector, but actually if you look at the long-term performance over 10 years in small cap, it's up there in the top 5. Out of 65 sectors over 10 years, it's up there with global, it's up there with emerging markets. So why is there this disconnect between money flowing in and actually the longer term performance? And I really stress longer term performance, because if you look at the short term, obviously the volatility is an absolute killer. And I actually think that the two aspects that we need to look at are, one is volatility and the other is obviously liquidity, and the two are obviously quite correlated. Volatility is probably there for a couple of reasons, and I've got some sort of fairly strong views on this. At the bottom end of the market, it's always a derogatory term to use about market cap, but at the end of, I suppose, the spectrum that we're looking at, and most of you in the room are looking at, i.e. under 150 million market cap, there is a lot of volatility. And some of that has been a legacy, I suppose, of the cleaning up exercise that Adam's talked about, but also some of it is some of our own responsibility. And I say own responsibility, meaning you as investors, you as, or us as investors, corporate bodies themselves, advisors, etc. And I think we actually need a bit of a wake-up call when it comes to looking at our own accountability and responsibility when it comes to investing and the way we present our investments. I don't want to talk about specifics, but it's almost impossible not to. Even in the last 12 months, very difficult markets, quite difficult to raise money. I'm not going to name names, but we've had one company raise £2 million coming to market by way of a rather interesting reverse. Within 12 months, the CEO has managed to nick the IP of the underlying business and take it elsewhere. There's been a lawsuit filed against the company by previous employees, which is significant. And of course that has probably culminated in its shares being suspended because of clarification of its need to clarify its financial position, and basically it's run off with the cash. So if that was one case and there was no others, I would probably suck my teeth and think, well, let's just get on with it and think about how we avoid that kind of thing. Fortunately, we didn't invest in it. We'd obviously done a little bit DD on it, but it was one case that kept reoccurring, and we could see the sequence of announcements coming through and thinking, you know, why on earth was this allowed to happen? It was allowed to happen, and it has been allowed to happen. I'm not going to mention names like Worthington Nichols, Aero Inventory and some others. That we've got a fantastic history in small cap and AIM of being able to create and grow very, very good companies, but we've also got a fantastic history of making some body bags and trip-ups for ourselves that we really should be able to avoid. And again, maybe coming back to one of Adam's points, there is oversupply in the market. There has been oversupply of companies in the market, and that's good for us. But we need to be collectively responsible. And that means, sadly, that I think actually the business model for advisors, brokers, whatever you want to call them, doesn't necessarily work in small cap, because it's driven by, their business models are purely driven on a transaction basis. As we know, the trading volumes as yet, and probably won't ever really support a broking model or a pure broking model. So there's probably oversupply in the corporate broking side, which is a sad fact, but it's probably been reality for the last 5 or 6 years, and it's still maybe not cleaned up to the extent that we want it to. Companies actually need to take responsibility in their boardrooms, and this is, I keep harking on about this, but it's a point that I do feel very strongly about. NXDs, non-exec directors and chairmen, are our custodians. They're shareholders' custodians, they're private shareholders' custodians, and therefore are absolutely responsible at the boardroom level to be the question mark to the executive team, but also to make sure that there's a bit of common sense when it comes to RemCom and option packages. I feel very strongly about this, and it's no doubt a point that we can come on to later. And then government and fiscal change. I think there are probably some structural changes that could be made that could make life just a little bit easier. For us, seeing that we could invest in AIM shares through our VCTs would make us, I think, much better investors and better support for the small cap market in general. And some of the other initiatives that we talked about in reform of CGT issues and AIM stocks and ISAs, I think really would make quite a major difference. But I think underlying to everything, in terms of my thoughts, are that we've got to, all of us, be a bit more collective in our accountability, and therefore clean up what has been a bit of a bad name when it comes to investing in small cap. And then over time we will see a better return to performance, and hopefully funds coming through over time. Over to you.
Right. I'm going to come over here simply to prove to Tim that I don't yet need a Zimmer frame. But there we are. Thank you for your introduction, Mr. Ward, sir. Afternoon, everybody. That's who I am. Yes, right. Now then, the other thing I'm not going to do really is sort of address all the questions, but perhaps just pick up on 1 or 2 points that Judith and Adam have referred to. I think the first thing to say is that even before, whatever his name, Monsieur Hollande was elected in France as the new president, I think economic growth was on the agenda. It was a point of debate. Where was it? Would we ever get it again? Could we have some more, please, given that we don't have very much to start with? And I think actually, if you go hunting for a second or two, you will find that it's there. You know, why do we see, whatever my two learned colleagues may have said, why do we see surveys from the QCA and BDO suggesting that optimism is rising? Why do we see earnings forecasts amongst broking analysts being upgraded every so often? Not as regularly now, I have to say, as we would like, or indeed as was the case perhaps 18 months ago, but it is still going on. And I think the answer is that actually there is growth out there. It's not easy, and it's certainly not easy to finance it with freely available credit, but it is there for a management team sufficiently determined and with a clear enough strategy to actually go looking for it and to achieve it. And I also think, actually, interestingly, probably good news given that the banks have closed for business, is that actually equity is moving up the agenda at the heart of government. I have no reason for saying that other than just a few suspicions. But I suspect that their understanding of small companies is on the rise. There are some advisors that have been appointed, although sadly, of course, there's no such thing, at least I couldn't find one on the website, of a Minister for Small Business. Is there one? No. There used to be in the last Labour government, but not in this shop. And of course, the other thing to say is that we do need to change the treatment of equity. It is taxed several times over, whereas debt, not only is it not taxed, it actually receives a subsidy from the taxpayer. So, I mean, the whole thing is barking bonkers, frankly. And hopefully we will begin to make some progress as far as the government's treatment and understanding of equity is concerned, because really the only way to finance small companies is through equity rather than through debt. And you may have seen one or two press articles recently quoting Xavier Rollet of the Stock Exchange, beginning to say just exactly that sort of thing. Now, I think we're here to discuss one or two things about what the government can do and perhaps views of the market. I think that anybody in the room who's 30 or 40, I'm not in either age bracket, of course, but you know that already, and you have your own SIP, you have your own pension fund, I cannot believe that any of you have a single gilt bond or any other sort of fixed interest instrument in it. I think you'd be bonkers to have one. I'm, as I say, not in either age group, and my pension fund is 100% in equities. That could be foolish, could be old habits, could be idleness. I don't think it's any of those. I think it's just common sense. You need to produce economic growth. The way to do so is to take an element of risk. And of course, the one thing no sane individual is allowed to do is to take a single bit of risk. There is an enormous regulatory panoply, whether it's the FSA or going to be the FCA or anything else, frankly, pensions overseers and all the rest of it, designed to make decisions for you, not allow you to be so stupid as to invest in equities. And yeah, need I go on? But suffice to say, they make the rules, they know what's good for you, and they're, I think, quite wrong. So perhaps if we could have a bit of joined-up government thinking, we could have the government putting pressure on the regulator, allowing individuals to make their own investment decisions, allowing them, with common sense, to make investments in equity, and I think then we'd begin to see perhaps a bit more capital flowing in our direction as a way of investing further in small companies. I don't think individuals need to be actively discouraged. And indeed, in terms of the government even having policies towards small companies, you would think that there's an obvious contradiction there. Well, there is. So, having said that you should be investing in equities, should you be doing so now? I think the answer is yes. I might be accused of bias, I might be accused of prejudice, but actually I think the answer genuinely is yes. There is growth out there. We are seeing it day by day. You're not seeing it in the newspapers, and you're certainly not seeing it on the blasted sort of Bear Corporation, but you are seeing it actually if you go looking for it. There are well-managed small companies making progress with innovative products and making progress with their profits, with their growth, even, dare I say it, with paying dividends, which of course is one of those things we might have to talk about too in a little while. It would help if there were tax incentives. It would help if there was some joined-up thinking. It would help if the government actually followed through on the flood of green papers it has produced in the last 2 or 3 years. There have been all sorts of things from both the Treasury and from BIS about funding small company recovery and all sorts of things. Have we heard a thing about them? Have they followed through on them? No. A bit more action rather than just consultation would actually be a good thing. I think the sad fact of the matter is, of course, that all those small company issues have been lost in the noise of other matters that have proved to be rather more important at the time. But don't worry, everybody. You know, the cycle does turn, and that's both economically and politically, of course. The cycle does turn. There will be a general election one day, and this government will be after our votes just the same as any other government. So don't worry, government debt's going up. You can have more of that in your pension fund if you want it. But they will be, I suspect, trying to look for ways whereby you can improve employment, whereby you can improve economic growth on a rather wider scale than they have bothered to do at the moment. The consequence of that is that I suspect that we will see some new measures for smaller company investing, whether that is around VCTs and existing vehicles, whether that is new vehicles, I don't know. But I wouldn't be surprised if there wasn't a mix of both. So I am an advocate very clearly of the idea that good, well-managed small companies are cheap. They certainly are. They're mammothly cheap because they are completely ignored and out of fashion. If you can find a way to tell the regulator to take a running jump, so well and good. Perhaps it should be the case that every pension fund in this country should have at least 10, if not 25% of their funds invested in smaller companies, simply because that would reflect some of the membership of their fund. I don't know, but it's certainly something that should have been thought about a long time ago. Small companies are definitely cheap. You have to assume, I suppose, in that the economy will one day recover. It will. It doesn't take, I think, an enormous leap of faith to suggest that that will be the case, but it will be. There may be 1 or 2 major problems to be sorted out first. And actually, I suspect there will be an awful lot of noise and throwing up of hands in the air, first of all, when Greece is thrown out of the common market or anything else, or the European Union it's now called. But you will find then that when the dust settles, actually, small companies are still growing, they're still doing business. They're doing it now without necessarily the aid of the banks. They're doing it with equity capital, and I suspect that when we will discover that there's something to be said for investing in them.
Andrew, thank you very much, and thank you to Adam and Judith for their comments. It's good to hear that the rare subspecies has a very strong voice and some very strong views about their sector and about investing in it. I'd now like to open the floor to questions and perhaps take 2 or 3 questions as we've done previously and group them together and see where that takes us. So who would like to ask a question of the panel? This is your chance. I'll ask a question in the meantime while you're thinking about it, but when you do think of a question, please put up your hand. Is the way fund managers are remunerated, does that affect their investment decisions?
No.
No?
No. I'm paid a salary, end of story.
And in terms of the cycle of companies reporting, does that affect your investment decisions? In terms of quarterly and half-yearly reporting and your own reporting?
No.
No, I don't
Just
think
a lot
so.
of no's, great.
No, sorry about that, Tim. No.
So what time frame would you look at a company in terms of investing? Over what period of time would you expect to get a return?
If you're investing in a startup, you might take, 5 years. If you're investing in an existing business, perhaps it's 3 years. There are slightly different time periods, I would say, for different types of companies at their stage of evolution. And there isn't necessarily a finite answer. But I think the difference is that we just don't regard buying shares in a small company as just sort of, counters on a roulette table. This is actually an investment. And as a consequence, we're looking for growth by that company, progress by that company over a period of time. And we would hope that in the space of 3 years, A, it happens, and B, you see it happening, and arguably it can continue thereafter.
I reiterate what's just been said there. I think we see, and I said before, we don't see the market as a good valuer of companies, so we can't depend on the market to value companies for us. So we've got to make a judgment as to whether what we think our intrinsic value, our entry value is, and whether that's reflected in the share price that we can get or not. So, and then after that, I suppose our return comes from a function of 2 or 3 things, and that is earnings growth, hopefully, or growth generally, dividends, share buybacks, or some other kind of catalyst. But the kind of common theme across all of those is actually just simply free cash generation, whether it's through dividends, reinvestment of the business into acquisitions or whatever. So trying to put a time frame on that, generally on the investments that we make, is quite difficult. But going back to, again, what we said about the performance of small cap, if you look over the long term, it's been good. If you look over the short term, it's been volatile. So I would always err towards longer term, and our funds are all structured that way because of it. So I don't think there's any set answer there.
I think I'd like to add a couple of things. I think the question is, if we rephrase it slightly, do fund managers do what they say on the tin? I'm not sure that the answer to that question is yes. I think both Judith and Andrew have one great luxury, which is most of the money, if not all, correct me if I'm wrong, they manage is permanent capital. And I think fund managers across the piece, including in small cap, do not universally manage permanent capital, and that gives you the flexibility and the freedom to make sure your investment objectives and time horizons are aligned entirely with those expectations. You can openly and candidly speak to your client base about when they should and at what time horizon they should expect to see a return. So unequivocally, time horizons, generally speaking, you look at it and say, right, anything between 2 and 5 years, and as Andrew says, you take a life cycle approach. Depends entirely what the value driver is in a business, and the value driver is entirely contingent upon where it is at any moment in time in its individual business life cycle. You aggregate that, and over time, consistently good decisions should result in consistently good returns. So, but my concern would be is there remains a very substantial mismatch between fund managers' objectives. The number of times I sit down with clients and they've been made promises about the level of due diligence that's been done, the amount of research that's been done into the quality of the balance sheet, the backdrop of management, market position, industry, all that kind of good stuff. But the returns profiles across the broader industry suggest that, that there's something awry, because most people persistently underperform. And until we've got some kind of permanent capital structure, or unless you've got some kind of permanent capital structure, I think it's very difficult for fund managers to make the commitments that Judith and Andrew do, which increases the vagaries of the volatility in the market. One of it's worth picking up on a couple of things that both Tim and Andrew alluded to. In terms of tax anomalies, and I'm loath to talk about tax anomalies, because the last time tax anomalies was used, it was in reference to pastry taxes. And we know the policy agendas that are on the table around CGT. My bugbear personally is CFDs. The tax advantages mean that it makes more sense for me to invest in the stocks that I like via a CFD. The only downside is if I get it wrong, I don't have a tax loss which I can use. But the majority of investors in CFDs are using leverage, and they will get stopped out in the short term if the market goes against them. So the tax advantages of the CFD market distort capital allocation. They distort and incentivize individuals not to use their ISAs, not to use their pension funds, not to use collective investment vehicles. And actually what companies need is long-term capital. And the current tax structure within retail is a disincentive to doing that. There's a similar pattern within the institutions. I mean, even if you run long-term money within this should be the time for the pension funds. It should be the time for the life funds. And I'm a little bit more optimistic, because there are developments in the debt market where they're starting to behave in a way you'd expect them. There's some very interesting moves from people like M&G and Aviva, where they've stepped in to fill the gap that's been left by the banks. Oddly enough, I think they could be more commercial. But for example, they are providing debt finance. It's just very conventional American-style bond market finance, long duration, but it fits with their business. It matches their liabilities. And they're providing debt finance to the likes of a Big Yellow or a Safe Store. Blue chip, small, medium-sized businesses at 5%. Now that's great for the business. It's great for those investors. And it's using long-term capital appropriately. I think the challenge is trying to get some of those organisations and the policymakers to do the same for the equity part of the market, because then you can start tilting the balance between the short-term objectives that asset allocation currently has, risk aversion currently has, or the structure of the retail market currently has on the ability of fund managers to provide capital with some degree of certainty to companies.
Donald Stewart from Faegre Baker Daniels. In the US, we've seen quite a lot of, there's actually now quite a sophisticated pipes market, people putting what effectively are private equity style investments into small caps. Is there a reason why, do the panel see a reason why that kind of funding isn't really available over here?
Andrew, would you care to have a crack at that?
No. I only say no. I have to say I'm not an expert on US pipes funding and that sort of thing. So I'm not sure that I really am the right person to answer it. I don't know whether it gets tax treatment or favourable tax treatment or not. If one assumes that it isn't and doesn't, I suspect that some of the answer why that sort of thing, as well as a whole host of other areas that we might have seen in America in the past, do you remember Brady bonds and all sorts of things like that, never seemed to sort of travel the Atlantic. I have to say I'm not quite sure why. I suspect the answer is as much to do with culture and with risk-taking and with being prepared to do so. which doesn't exist in this country, or if it does, it has to go on in a rather sort of subtle and quiet way, simply because the regulators take such a draconian view of it. You can't really be advised to do that sort of thing. So you've got to find the company that needs the financing by yourself. You know, the man on the Clapham omnibus has got to do it himself. And that is very difficult. Even the business angel networks that exist find life quite difficult in many respects, as far as investing in startups, investing in things where traditionally 8 out of 10 go bust, but the other 2 make small fortunes. It's becoming more difficult to advise people to do that sort of thing. So I don't know if that answers your question, but I suspect as much as anything it's a cultural issue rather than one of regulation or legislation.
A couple of quick thoughts. For those who may or may not be familiar with the term private investment in public equity, actually, when you boil it down, that's probably what everybody on this panel does. The interesting thing in terms of capital flow is we've had for a number of years now an increasing proportion of our investment comes from overseas, and particularly the US. And if I take over our product, we don't run VCTs. We run product which is very similar in style to VCTs. And in fact, Judith, another confession, Judith is fully aware that we had a good go at launching something on the VCT front because of VCT qualifying investments. We probably hold, a good 20-25% of those names. And it's hard enough for those with a track record who haven't let their client base down to raise money, never mind a new entrant come into that space. But the people who do listen to us are American. Because if we go to the States, whether it's Chicago, New York, or whether they're coming over here and we tell the story about our asset class, their eyes open up and say, well, isn't that just private equity in private investment in public equity? Well, broadly speaking, that's exactly what it is. So with Andrew, I don't think there's, I'm not on top of what the tax structure and the incentive behind that is. There's clearly a very different attitude to success and failure in the US, and a willingness and a preparedness to fail that feeds through into culture. And I think perhaps Judith and Andrew might be able to talk more specifically about the attitude of even VCT investors over here. Their starting point, my impression would be, is their starting point is capital preservation first, risk aversion first, which was obviously not what the whole market was originally set up for. It was set up as a risk capital growth investment. So there is a very significant cultural obstacle to overcome. Actually, the short answer is I think private investment in public equity exists just by a different name in this market. But where that money comes from tends to come from our perspective, the people who will back that are wealthy family offices, high net worths, and US, if not US pension funds, US investors.
I suppose our experience is slightly different. We have been out of our VCTs, which are an absolute nightmare to invest out of, into AIM companies. We have been investing general loan stocks, fulfilling that debt position, which has been, again, a really good hunting ground over the last few years. We can write relatively competitive terms, actually competitive for the company as much as anything else, and also good for our funds, which give us in terms of risk profile, a degree of security, because we're taking a charge over assets such that they are, and we're also taking the equity element. The one thing that's really frustrating, and I'll come back to this point, when you're investing out of VCTs, that you're having to buy new shares, that qualifying element. And actually, if you're putting together a kind of holistic solution for a company, you want to be able to pick up stock in the market, pick up stock from, say legacy shareholders, and make sure that actually the on-market bit is sorted. The debt position, loan stock, convertible or whatever, is the right solution for the company and aligned with shareholders. And you want to maybe be injecting in new capital through equity as well. So there's one part of that equation that is missing and difficult for VCTs, and that is going back to the buying the old equity element. And we try and address it by, and it's a massive conflicts, but all different boards, we try and address it by having a small cap fund sitting alongside that doesn't have the same restrictions. But that in itself has obviously got its own issues. So yes, I suppose the answer to the question is we are trying to do it in a very, very small way in the VCT market, and I think actually other investors in the VCT market are doing it as well. But we have to find our own deals, we have to go out and hunt for them. And that again takes time. So it means that the actual deal execution for that type of investment, the number that we've done, probably out of a portfolio of about 20 holdings, we might have four that we've got a loan stock and equity solution in, and we've got another couple in the pipeline. But we are looking, and that's our ideal structure for VCTs. But they're hard to come by, and actually I think that addresses that structure addresses some of the risk aspects that some investors don't like. So it's the sort of structure that we're trying to put in place, but it's not easy.
One of the question here, Stephen.
It's slightly different tack, but one of the things you're saying is your investors, your long-term capital. And of course, we've been hearing all the politicians saying that the trouble with the bankers is it's all speculators, and there's too much trading, and they want to tax liquidity. And of course, when we went to see, as a previous QCA event, we went to see our market making, and said the trouble with forbidden technologies, you've got too many investors and not enough speculators. There's not enough trading going on. So I wondered, if you're not that convinced by the market values of companies because of their dysfunctional market, do you actually take into account liquidity when you decide whether to invest?
I suppose we would look at, and going back to the philosophy of, I wouldn't buy 1% something that I'm not 100% sure about. So I take the view when we're doing our diligence that we would be buying all the companies. So liquidity is obviously an issue as well. We've maybe got a bit more flexibility because we've got different funds that we could invest out of, so we can buy smaller chunks and then be able to build up to a larger chunk. But yeah, liquidity is if you can't get hold of the stock in the first place, why are you bothering looking at it? But we've probably got more of a spectrum of size of funds that allow us to trade down to very, very small quantums, and also then be able to support share prices as well as you make that investment. But we're a bit of a strange beast, and we've talked about the different types of funds that you can have. Captive and long-term funds are obviously the best. VCTs are a bit of a nightmare to invest out of. And open-ended funds are, it can be even more difficult. So, I suppose what I'm trying to say is understand the different constraints that the individual funds have got, and that actually flows into the effect that might have on you as a company as well.
Andrew, when it comes to volatility and liquidity, what's your take on?
I think I can think of two companies I've invested in that were thundering great mistakes. Both of them had chief executives who sat on something more than 60% of the equity. And they may have floated with the best of intentions to reduce that down over time. But it never happened. And actually, one went completely the other way, and the other went bust. It is now a rule. I would never, ever, ever invest in a company where the boardroom owns more than 45% of the company. It's just not going to happen, as far as I'm concerned. Which I suppose is a long way around saying, yes, liquidity does matter in some instances. And it isn't really a function of liquidity in that instance. It's more a function of whether you genuinely want to be a public company. And if you do, then you're not going to mind having only 45%, frankly. And that's that. Liquidity is an issue in some portfolios that we manage at Octopus for particularly inheritance tax purposes. If someone dies, sadly they do, and the beneficiaries want the portfolio, then actually, yeah, you do need to be able to sell it. We get round the problem by having a substantial number of holdings, and therefore nothing is particularly large, and therefore we can achieve liquidation of the portfolio if that's required. The other issue is that if you are taking a view of perhaps 5 years, then I suspect even Judith would admit that, where she does that, then the answer is that you're not really thinking of selling the stock. So whether there's no liquidity today or whether there's wonderful liquidity today, frankly, isn't relevant. What you have to take account of and have to work towards is a better state of liquidity in 4 or 5 years' time. And that's the crucial thing. And that is all part and parcel, I would guess, of a company growing up, the management growing up and learning what it is to be a public company, at least from my perspective. Volatility, well, it's just one of those things, isn't it? I'm not sure that, I don't know what the others think on this panel, but I'm not sure that actually we think we can do an awful lot about it, frankly, at the moment. It would be nice to think that we could. It would be nice to think that the market makers were benevolent charities. Sadly, they're not.
Adam.
I think the point about liquidity is it works for you as well as against you, and investors obviously often forget that it works for you. When we're making investments, and clearly you have to go horses for courses depending on the characteristics of the fund, and that's paramount to thinking. But let's for the sake of argument, just assume we're taking a half-decent investment in something that's pretty liquid. I'd extend Andrew's thinking. We wouldn't put a necessarily hard and fast rule around percentage management or board control, but we would throw in there, we would look at the whole shareholder structure. Part of the issue around volatility and joining it in with liquidity is trust. It's trust not only in the board, it's trust in other shareholders and other stakeholders in our game. And you want to have some confidence that they are aligned with your objectives or in control of their own destiny. So, an analysis of the shareholder structure in that respect becomes important. And I think before the investment starts, you have to have a very realistic conversation about plan A, B and C. There has to be an eye on a liquidity event, which means that there is an exit. I think you have to be candid. What is the objective? And are those objectives realistic, both either in terms of the growth opportunity being so strong that it reveals itself in a significant uplift that catches others' attention, and you're going to have the opportunity to sell into that strength, or corporate activity. What is the end game here? So the liquidity event on an exit is an important part of the conversation. You can't go in blind at the outset.
Okay, we've heard that we've seen money outflows from the sector going towards emerging markets. There's a bit of a clearing process that's been happening. Failure is seen to be a good thing as part of that clearing process. That performance over the longer term in the sector is good. And some sense that growth is there and that equity is moving up the agenda. Also that when it comes to the way equity is treated, equity is taxed and debt is subsidised. So we're seeing that there's perhaps an unlevel playing field. I'd like just to end this session just by asking a question of each of the panellists. What are the one or two things that you could see being put into place which would have the biggest impact on the sector over a shortish 3-year period of time, if there was a policy implementation or a change that would happen? What are the one or two things that you think would have the biggest impact on the sector? I'll start off with Andrew. We'll come down this way.
I'm being picked on. Have you noticed that? It's always me first. I suppose the biggest single thing for smaller companies, and it doesn't to some extent matter whether they're private small companies or quoted ones on AIM or the bottom end of the full list, is that actually we start to put in place perhaps a few regulations. Some people I know would strongly advocate the that employment law didn't apply to any company employing less than, say, 100 employees. Others would advocate that there should be a wider range of and rather better firm tax breaks for the owners of equity in small companies. I think, to answer your question, Tim, I would say that actually there needs to be a certain amount of joined-up thinking that does pull together a number of those sorts of themes. We actually need to make it easier for entrepreneurs to start. We actually need to make it easier for people to grow their businesses. One of the interesting sort of cultural divides, arguably, that distinguish this country from America, perhaps, is the fact that an awful lot of people think they're going to start a small company and grow it to a certain level, and then they'll sell it. Selling it at a point, whatever that point may be, it will vary from company to company and marketplace to marketplace, and indeed perhaps from founder to founder. But selling it is the essential thing that they do. They don't go on growing and growing and growing. And I suspect that we do need to do something in this country, which means government action, government stimulus in some form, which allows us to continue to grow our companies rather than incentivizing us almost to sell them and pocket the proceeds. That means probably that companies do need to be able to have freer access to equity. It does mean that there need to be fewer taxes on equity, and perhaps therefore some levelling with the debt field that you produce, either tax on debt, or you stop making it tax deductible at the very, very least. And I think then we begin to see perhaps the chance for people to continue to grow their businesses over many decades rather than just over a few years. So I suppose the short answer to your question is that if we could level the field between debt and equity, if we could start to regenerate the fashion of investing in equity, then we will go a very long way perhaps to improving the employment situation and the growth situation.
Thank you, Andrew. Judith?
Very simply, I think, going back to Andrew's point, entrepreneurs' relief and sorting out the CGT treatment would go a million miles away or give us good headway in terms of addressing some of the tax issues around gains. Obviously, an issue of mine is being able to access the secondary markets through VCTs, which would make an awful lot of difference, I think, in terms of just the general secondary market in some small cap shares. And going back to a point that I think everybody's made, if we could open up pension funds' eyes and also direct investors' eyes to a pension fund allocation of small caps and an alternative asset of some sort, that would make quite a bit of difference in the buying side and the amount of volume that's going into the market. So I think those three elements would change life quite considerably.
Have we any actuaries or pension fund consultants in the room? Maybe. I might just tone down what I was about to say anyway, just in case. I think we need to free the number of times you sit down. It doesn't matter what part of the asset class, the broader investment community someone comes from. They always say, "Great idea, Adam. Love what you're doing, but I can't sell that idea." There's a very interesting and radical debate just surfacing in Scandinavia, which has really caught my eye, and it's the idea of throwing away discount rates. Or mark-to-market discount rates for the pension fund industry. It's insane that, with treasuries ridiculously low, that you mark-to-market the liability, and because you mark-to-market the liability, you raise the conservatism of the asset allocators, and they become even more keen to invest in bonds when they're at ridiculously low yields. So to combat that, there is a debate just surfacing in Scandinavia where you raise the discount rate and just put in. It's arbitrary. It's always going to be arbitrary, and it's always going to be an element of an art. But pick a number. Whether it's 5, 6 or 7, it kind of doesn't matter. Free the trustees, free the investment managers, free the pension fund consultants and the actuaries to stop being so mechanical about the calculation of the liability and focus instead upon the cash flow of that liability and ultimately and therefore think about an investment return starting today. And I think that will then start enable that part of the industry to make more sensible investment and asset allocation decisions looking forward. So that's the big win for me. I think it's an early stage debate. Aside of that, I do have great faith in markets clearing, and they clear at the stock specific level, and ultimately they clear at the market level as well. But for that to happen, it's a little bit pithy. I think investors just need to have a good experience. Those who are prepared to look long term end up with that good experience. Until people see that a story is starting to work, it's only then that they're prepared to jump on and believe the rhetoric behind it, or believe that the rhetoric has substance. It sort of goes back to Judith's point about collective responsibility of the industry. But the markets will clear, and eventually investors will get a good experience, and that money comes back.
Thank you very much, Adam. I'd just like to add that creating the right environment for the engines of growth is incredibly important, and clearing out the regulations for those engines of growth is one aspect, but it is very much about incentivising the fuel and getting the fuel in, and that's where the fund management industry plays its part. It was interesting earlier in the proposed, as I understand it, is for any company whose revenue is below $1 billion. So when we're talking about jump-starting our business startups, there's a certain sense of vision and a sense of scope which I don't think we have in this country or across Europe yet. And I hope that we do start to move towards that. But it's very clear that we do need to encourage the policymakers and the regulators to see this asset class as an asset class, and to introduce the whole concept of that so that they can differentiate and positively discriminate towards this asset class, so that we get more fuel into the engines of growth. In the same way that listed companies now have to state what their policy is towards diversity, I think every insurance company and pension fund should have to state what their investment policy is towards this particular asset class, so that then the consumers can make their choices about which insurance companies and pension funds they choose to follow. That completes this particular debate. We've got